Another tool that the Federal Reserve has to control the money supply is to change the reserve requirements that private banks have to meet. So the reserve requirement is how much the bank has to keep on reserve and they can loan out the rest. For example, if you have a 10% reserve requirement, the banks have to keep 10% on reserves. They can loan out 90% of the money. We know that by making loans, that creates actually more money in the overall economy. So if the Federal Reserve raises the reserve requirement, let's say they raise it to 20% reserves, banks can't make as many loans, there's fewer lines of credit, and that will reduce the money supply. If the Fed wanted to raise the money supply by changing the reserve requirement, they would lower the reserve requirement. Let's say they lowered it down to 5%, so from 10% down to 5. Then banks can make more loans, there becomes more lines of credit in the economy, and money supply increases. Now, typically the Federal Reserve will not change the reserve requirements because that would be usually seen as disruptive to the banking sector. So, for example, if you set up your bank based off the government regulation from the Fed that you have to have 10% reserves, and they then all of a sudden say, oh, you need 20% reserves, that would obviously be disruptive to your banking model and probably create additional risk in the economy that we don't need to see. So there's other ways for them to control money supply, so they typically do not change the reserve requirements to impact money supply. One other thing just real quick about the new tool that the Federal Reserve has, and this is after the financial crisis, the Fed got the tool here, and it's the ability to pay interest on reserves. So what the Fed can now do is the Federal Reserve can pay a bank like Bank of America interest on Bank of America's reserves. So typically, if you think about it, a bank will make money by making loans, and then, they make a loan, they earn an interest rate off that loan. Here, the Fed will pay them just to keep it in the bank. So this is a tool that they now have. For example, if inflation is picking up, the Fed doesn't want as much money going out of the bank, so they start paying interest on reserves to those banks. So then those private banks can earn money by just keeping it in the vaults, so they're less likely to loan it out. So this is a new tool that the Fed has had since 2008, and we'll see how it operates in the future. So right now, inflation isn't that high, so they haven't really been paying much, if any, interest on reserves. But the idea is if inflation picks up, we don't want that money making it out into the economy, into circulation. The Federal Reserve will then pay interest to the private banks to keep it in the vaults. So it's a tool that we're hoping, or the Fed is hoping, will be able to more precisely control the money supply.